Get the power to do more with storable software. More automating, more control, more revenue, more time back in your day. Storable helps operators do more with the most powerful technology in self-storage. Learn more at storable.com/do more.
Good morning, good afternoon, everybody. We appreciate you guys taking time out of your busy schedules to come join us for today's webinar. Today's topic is going to be on this idea of market corrections. So we've seen quite a few higher order US economy type market corrections, and we wanted to talk about what are those things, what are we tracking, and then most importantly, how does that affect the self-storage industry, and what can you as an operator do to position yourself against those things and make sure that you're coming out the other side looking good. So quick introduction, my name is Matthew Beal. I'm a product marketing manager here at Storable. And I wanted to give you a quick overview of kind of what this webinar series is. So again, this is a continued webinar series, and this is just a part of a broader session. But there's been four more main forces that we've been tracking that are actually all going to end up being relevant in today's discussion. Number one is this concept of shift to digital. So over the last few years, we've really seen operators and especially tenants shift over to preferring digital forms of engagement more so than they ever have before. We also had this idea of a supply crunch, and this is one we're going to get into today. It's actually kind of a symptom of broader market issues, but the idea here is that we are at record high levels of occupancy across the industry. So we have way less demand than we do tenant supply, and so this has some really unique impacts to the way that you run your business. And we also expect this one to potentially change a little bit in the coming year, so we'll talk about that momentarily. There's also this concept of growth via M&A, or you might call this consolidation. So we've seen a whole bunch of medium and large size operators sell to even bigger, larger sized operators, but we've also seen quite a few 1 and 2 facility operators who are maybe a couple years of getting out of the industry, starting to see cap rates as low as they are and all these opportunities to sell at just a really, really strong price. And we've seen that really uptick over the last couple of years. Again, this one is something we'll be discussing a little later. And then lastly is the idea of market correction. So this is kind of the fundamental concept we're going to be discussing through today's presentation. And the idea here is that kind of as more and more time is passing, it's becoming evident that a lot of these other symptoms that we're seeing on this slide here are really symptoms of a broader shift in the market. And so we're in the early stages of what many economists are predicting to be an imminent recession. And it's a little too early to tell for sure exactly what parts of the market are going to be affected, what the severity of it is going to be, what the exact timing is going to be. But the good news is we're still kind of in the early stages of that shift. So today what we wanted to do is talk you through what are all those different forces we're tracking to kind of enable you to also make your own opinions on where we're at and where we're going. But we also want to spend the second half, and I would argue the more important half, talking about how we see this affecting the self-storage industry and what operators should be doing to position yourself against it. It's much better to be early and proactive about these things than it is to be responsive once it's too late. So what do we mean by market corrections? I mean, we talked about that briefly just a moment ago, but what I will say is that there was a recent Bloomberg survey of economists who put the odds of a recession at in the next year in particular at 30%. And so this time last year, that was down, that is up from what was 20% this time last year. So those odds are just increasing, and more people are believing that it's if not imminent this coming year, it's definitely going to be in the next couple of years. But there is a number of economic signs that they are using to kind of back up that claim. And some of these factors definitely might seem a bit complex. They might seem a little bit abstract, but they have been proven time and time again to be reliable predictors of this type of market correction. And so today I want to walk you through what some of those most common and most powerful and reliable indicators are that are being cited for this. And there's three we're going to discuss. One is this idea of an inverted yield curve. So the idea is that the bond market is usually a really, really good indicator both of when you compare short and long-term returns on bonds. There's a phenomenon that occurs that long-term bonds actually end up being a different valuation than short-term bonds as you would normally expect. So we're going to dive into that here in just a moment. Next up is this idea of a speculative bubble. This is the one I think people are probably feeling the most pressing right now. So whether you look at the stock market or whether you look at cryptocurrency, if that's your thing, all of these speculative markets are really starting to correct very, very aggressively over the last 6 months, and I would say even aggressively over 12, but it's been real bad this year. And so this is having a really significant impact on some of the more stable aspects of the market, such as self-storage. So we'll dive into that. And then lastly is inflation and rising interest rates. So if you watch the news, you read a newspaper, you know about this one. It's being discussed everywhere right now. And so the idea is that we have multi-decade record high inflation rates. I think it's either 8.3 or 8.5 was the most recent number cited. And that is to be able to combat that and to make sure that consumers continue to spend money. The Fed is, or sorry, I should say the opposite, so that we prevent them from spending money. The Fed is having to raise interest rates to be able to combat that. And so this is another one that has impact on an operator from a few different perspectives, specifically like asset valuations, for example, but it really affects tenant behavior. And so we're going to dive into that one a little bit deeper here in just a moment as well. So let's start with the inverted yield curve. So if you think about long-term bonds and short-term bonds, there's some stuff that's probably pretty self-explanatory here, but just to cover it, you would expect that a 10-year investment, if you're going to buy a bond that pays out in 10 years, your risk is going to be pretty low because I think pretty much historically over the last 100 years, we've seen the US economy continue to grow. So you would expect to continue to get a return on that, but that return is probably going to be relatively low. If you have low risk, you're probably going to have a low return. Short-term bonds, by contrast, it might be a little bit more risky. It's still a bond. It's not the stock market, but it is significantly more risky than a 10-year bond. But you're also going to get higher returns for taking the risk on that. But what we are seeing here is that long-term bonds are actually having a higher rate of return than short-term bonds right now, just given the risk, the amount of risk that the investor is incurring over these periods of times. And so over the kind of over the long term, this is like one of the strongest signs of an imminent recession. And so I want to kind of look at this plotted out over a period of time to just kind of back that up, right? What this really is showing is that there's potentially a negative market sentiment for the country's future economic outlook. That is what we are seeing when we see this inversion of long-term being more valued than short-term. And so the last couple of times that we've seen these really significant inversions are back in the 1980s, which for those that are familiar, you can see there's a whole bunch of time we spent with an inverted yield curve there, everything below the red line. And as you guys know, there was record high inflation back then, and it was a really big issue that took quite a bit to get turned around. And the inverted yield curve was one of the earliest predictors of that, right? We saw the really bad behavior starting in the early 1980s, but as you can see here, we actually hit that inversion point in that mid to late 1970s. So again, it is a predictor of an imminent recession, not a sign that we are currently in one. So you play that out, and you can look in 2007, 2006, where we just barely dipped below. And as we know, we had an imminent recession back there in 2008 as well, or I should say not imminent, but one that actually played out. And then lastly, you can start to see here, this data is a little bit old. It's kind of hard to get this stuff super accurate for like a month-to-month basis, but you can see that as of this past year, we're right there at zero. And officially as of October, November of last year, we inverted the yield curve. So that usually means within the next 12 months or so is when we start to expect that recession. So this is kind of proof that we're expecting one here pretty soon, because again, this has predicted the last 7 recessions very, very accurately. The next concept is a speculative bubble. So a couple ideas I wanted to cover here. First is back in the early days of the pandemic, the Fed printed $4.5 trillion in aid to be able to help the economy. And in addition, they raised interest rates to they lowered interest rates to 0%. And the whole idea by this, right, during the pandemic, we saw record high unemployments of 14.8%. So they had to take some pretty aggressive moves to be able to get things back corrected and make sure that consumers were still spending money in the economy. And so we saw, though, what ended up happening was it wasn't just money that was being spent on, your normal daily goods and services, but we also saw that investors started getting significantly more aggressive with that extra capital. And so in particular, there was a cohort of folks that I'm, for the sake of ease, calling the millennial generation, but really it's just the younger generation who saw this money, they got this money. They also were sitting at home, maybe working from home, but stuck without anything to do, kind of equipped with a lack of understanding of how the market fundamentally works. But most importantly, when you're that young, you have a significantly higher propensity for risk. If you lose $1,000 when you're 30 years old, it really doesn't mean anything, right? Comparatively, that's how they think about it, comparatively to where if you lose $10,000 in your 50s or whatnot. It's just a very different fundamental equation in terms of how they evaluate risk. And so what we saw is that those folks in particular invested in the spaces that they thought they knew. And so that was almost exclusively the tech sector, right? So we're not seeing a lot of diversification from this new kind of high risk propensity group. We saw them investing in things like technology stocks because that's what they grew up with. Those are the companies they understood. And so where it got interesting, though, is that these tech investments were not necessarily good investments. And so I want to take you through kind of some examples of what we saw there, because I think it really does a good job of explaining kind of the craziness in the market over the last few years. So there's three companies I wanted to focus on the small cap side. So these were technology companies that are really, really relatively small compared to your Apples and your Netflixes of the world. And one of the quickest ways to be able to measure kind of the health of a company's stock price to determine whether it is accurately valued or not is to measure the enterprise value to revenue. This is a ratio, EV over R is how you'll see it abbreviated more often than not. And so this is just a multiplier that really, really quickly gives you a good look into whether or not a company is undervalued, overvalued, or valued just properly. And so in a normal, stable economy, we would expect for a really healthy company, maybe not like a rock star, but a very healthy company, to be valued somewhere between a 5 and a 10 enterprise value to ratio, enterprise value to revenue ratio. So by contrast, though, let's take a look at these three kind of smaller stocks that were in that space that were seeing a lot of big surges during this time. So about 12 months ago, Lemonade, which is a company that is kind of an insurance marketplace, it revolutionizes the way by which you can shop for a whole slew of different insurance options instead of doing the legwork your own. They were valued at a 105x ratio. So again, 5 to 10 is a pretty healthy company. This is a 105. It is a massive difference. It was insanely overvalued compared to the revenue that they were pulling in. So people were just betting on the futures of these companies performing at a higher clip. But what's happened is over the last 12 months, you can see they've taken a huge hit in their stock prices as we've started to see these kind of market corrections and things start to normalize. AMC Theaters, which is a little bit more of kind of a household name there, has a 75x multiplier a year ago. They're also significantly down. Fiverr, same thing, 60x multiplier, significantly down since then. So you might be thinking to yourself, well, okay, but I also don't want to invest in the small cap stocks. That's a little bit too risky. Those things move a little bit too quick. It's hard to really understand. It's probably more of a blip on the radar, right? Well, look no further than the notorious FANG stocks, right, that you'll hear every investor talk about. So whether it's Facebook, Amazon, Netflix, and Google, these were kind of the big tech stocks over the last really over the last 15, 20 years that have just felt invincible, right? You throw as much money as you possibly can in there because they just continue to grow and grow and grow. Well, what we've seen is that even though as of about 6 months ago, their enterprise value to revenue were up 70%, 5%, 18%, and 42% year over year. So they were continuing to grow in this way. They definitely were looking overvalued. Well, we've started to see some really significant corrections there too. And that's what you're seeing on the right column here, right? We're down 40, 71, 26%. I mean, those are really, really big numbers. And a lot of people had a lot of money in those companies. So. And so it's important because as folks are kind of seeing more and more of their stock portfolio vanish, the appetite to spend elsewhere is also going to diminish, as you might think, right? You don't have the capital necessarily to go spend elsewhere. And so that we'll revisit that, what that means for the self-storage industry here in just a moment. But the last US economy metric I wanted to look at is this concept of inflation and interest rates. So same arrows pointing to the same places as last time, looking at the 1980s, looking at 2007, and then looking at today, you can see a pretty consistent trend that interest rates are higher than they've ever been. So why is that right now? Because I will say the reason behind why it happened in the 80s, 2008, and then today, they are all different. Well, what we're seeing right now is we just discussed how consumers are spending more and more money coming out of the other side of the COVID-19 pandemic. But we've also seen some other market forces that are really interesting here, such as significant supply chain issues and labor constraints that I know for a fact folks in this industry are feeling the pains of. And so when we have this high demand and people have all this influx of cash from the last couple of years that they were willing to spend, again, 4.5 trillion being printed, but now we have lower and lower supply, that is just going to naturally lead to an increase in prices. And that's what we're seeing here with this interest rate increase. So now we're starting to see that the Fed is having to raise interest rates to combat it. And for those folks that saw yesterday, there were actually some meeting notes leaked from the Fed indicating that we're probably in this coming month due for another half point spend. So that's a little bit of, it's a leak. So take that for what you will. We'll know, I think June 10th is when they're announcing the new ones. But regardless, it definitely seems like we are not expecting to see a downturn on this. If anything, it's best case scenario probably going to be flat. And so this is another one that is, or another early indicator that this is likely to kind of be true, is that the housing market, right? So whether it is housing demand and housing prices, that's another one that we've just seen kind of go crazy, and we're expecting to kind of start to see normalize as a result of these inflationary effects. So that's the U.S. economy. But I think what most people probably attended today's conversation on is great. How does that affect me, right? How does that affect this industry, and what are we expecting? So to be able to understand this, I want to set a quick little bit of groundwork. I know everyone's probably very exhausted of talking about COVID-19, and I'm not going to spend a lot of time talking about it. But what I will say is there's some really important forces and things that were happening in the early days of the pandemic that have led to kind of the current market conditions for self-storage as well. So one is that, in the early days of the pandemic, operators were forced to go remote. There were losses of jobs in other sectors, not necessarily the self-storage industry as much, because we were classified as kind of this, necessary service. But that the loss of those jobs and the kind of the loss of things like construction projects and whatnot led to a whole bunch of supply chain issues. So steel and lumber are the most two notoriously cited kind of costs of building in the storage industry in particular. And steel was such an interesting one because what it really was, and now that we're being able to do kind of a post-mortem, is a lot of the companies thought construction was going to come to a total halt. So they stopped with their supply and they let a bunch of people off, thinking the pandemic was going to hit them harder than it did. But then industries like the self-storage industry actually needed to, and were more than willing to pay for steel and to continue buying it. So it's the same idea of kind of forced low supply, but with very high demand that has increased pricing significantly in that sector. And so it's going to take them probably still another couple of years before things normalize. I think lumber is starting to get there, but we're seeing that steel is still, just talking to various operators about construction projects, it sounds like that one's still got a ways to go. That's a very, very high demand. But meanwhile, so we've got this low supply environment in the self-storage industry where people would love to build, but they can't necessarily because it financially isn't viable. And so tenants have they continue to demand storage units. So we've seen more and more growth in terms of people needing these units. We just don't have anywhere to put them. And so this led to what we call the supply crunch that I alluded to earlier. And so what I really mean by that is, the easiest indicator to look at from an operator's perspective is occupancy. So what you got here is 2019 all the way through 2022 measuring occupancy percentages. And as you can see here, there was a massive jump from 2020 to 2021 in terms of occupancy percentages. And so far this year in 2022, we have not seen that decrease. You can kind of see it flattening out towards last year's levels, but it's still way over 2020. So operators at these record high occupancy percentages, so you would expect them to increase their prices, right? How do I get more price per square foot and maybe get some less, more price sensitive consumers out and some less consumers in? So we have seen that. We have seen, again, this teal line of 2021, you can see price per square foot across the industry here has just continued to rise at a really, really accelerated clip. And in 2022, again, it might be flatlining a little bit, but it's not really decreasing much, and it seems to be consistent. And I've talked to operators, ones in particular that are, very aggressive with their rate increases. It's a very normal part of their operation. I've heard of folks that are, over a period of a year, attendants may be paying 50 to 75% more than they were paying for their unit the previous year. And those people still aren't moving out. So this is really interesting for us in the self-storage industry. So what does this mean for self-storage stocks, right? So if that's kind of the behaviors of what's going on in the industry behind the scenes, we talked about what's happening with the overarching stock market, outside of our industry, mostly in the tech sector. So what does this mean for us in self-storage? Well, as you can see here, over the last 3 months, we have actually seen, and actually it might be 1 month, I'll be able to check my notes here in just a moment, but in the very near term past, we have seen a 20% drop in self-storage REIT stock prices. And so we know that the self-storage industry is fairly recession resistant. That is something that has been proven time and time again. And I would especially point to the 2008 recession, where we actually came out looking really, really strong compared to other industries, and especially in the commercial real estate space. But despite all of these things like really high occupancy rates and really high rental rates and revenue growth that we just discussed in the previous slides, we're still seeing this 20% drop in self-storage REIT stock pricing. And it is over the last 30 days. So that's just in 1 month, a 20% drop. So you got to think that means they've obviously fallen on tough times, right? There's something we're not seeing. The answer is no. So if you look at the initial 2022 guidance provided by 4 of these 5 REITs, in early Q1, or like coming into this year in January, these were the predictions for their year over year same store growth. So for folks that have been around a while, year over year growth of around 10% is phenomenal. That is already a very high prediction compared to what we've seen historically. But what's even more impressive is, okay, so if we know the last 6 months have been when people are starting to see this tech market kind of corrections, the overarching stock market corrections, the speculative bubble, all these kinds of things happen, you got to think, okay, well, we're probably going to pull back on those same store growth projections. But they update these every single quarter. And what you can see is every single one of these companies has actually increased. They have raised their guidance on what they're expecting from same store growth. So it kind of leads to the question of just what's going on here. Why is that? Why the pessimism, right? So the reality is the stock market is something that kind of responds in a monolithic way at times, just meaning that when we start to see a bearish nature of the stock market start to take over, which we are certainly seeing over the last 6 to 12 months, the reality is it's going to drag down everybody. And that's why we're seeing that 20% increase or decrease in the REIT stocks over the last chunk of time. But the reality is the fundamentals behind your stock are what are most important, because things will inevitably correct and they will get back on track. And so we don't see any sort of negative sign here that we're concerned about overall performance in the self-storage industry. There's nothing in tenant behavior. There's nothing in the overarching stock market. It's just more of kind of a bearish nature of the market that we've seen. But there is another thing for us to just kind of consider. I alluded to this previously early in the call, but all these different things like the speculative bubble and rising inflation rates, they are going to impact tenant behavior, which does impact our business. So it is important for us to think through kind of what is going to happen from a tenant's perspective to make sure that we're just thinking through that properly. So a couple things I want to discuss with you guys. Number one is that there's likely to be this kind of new cohort of folks that are going to be having to reevaluate their budgets. So again, if my house value is starting to go down, or maybe I'm losing my job, if unemployment starts to climb as inflation rises, or my dollar just doesn't go as far as it used to because of inflation, then it's reasonable to expect that you are going to see some tenants that are more so cost conscious starting to move out. So all these aggressive rate increases will probably start driving some of the behaviors that we've expected for them to drive over the last year or so. And so that's also, I alluded to it in the previous one, but the idea is that there are going to be tenants actually downsizing. And so this is kind of the other side of the coin. So you might think that's a bad thing, but obviously in the self-storage industry, that's not the case necessarily. So if folks are downsizing, a lot of the times they need a self-storage unit to be able to kind of make up for that difference. If they're moving into a smaller house, they're going to get a storage unit to store all their extra stuff until the times are a little bit better for them. And so all in all, we expect that to kind of be net neutral for us. We expect that there's going to be certain types of people moving out, certain other types of people that need storage that didn't necessarily need it before. And so what that does mean is that you probably are going to have to kind of think through, how do I start driving demand to my units again, something we haven't had to do over the last couple of years. But we do expect probably occupancy percentages maybe to decrease a little bit, not maybe at this 95% that we're seeing so consistently from operators, but maybe more normalized, maybe closer to a 90. And we might have to start thinking about things like our marketing website and other marketing channels more so than we have in the past. Another topic I want to briefly touch on, and this isn't necessarily Storable's forte. So what I wanted to do is I wanted to give you guys a quick introduction on, if you guys are not familiar with Marcus and Millichap. So for those that are not familiar, they are a service that provides real estate brokerage, mortgage brokerage, research, advisory services, pretty much all things commercial property, commercial real estate. And so they just released a really phenomenal resource on this idea of like, how is the market, the fluctuating market forces, how is that going to impact the valuation of my asset, my facility? And so there's a couple things that I thought that they brought up that were super interesting. Number one is, before I get into this, is most investors think about a direct correlation between cap rates and interest rates. And this is a good thing for you to think about. That is a generally accurate guidance. So as we see interest rates climb as inflation climbs, you would expect for cap rates to go up and the valuation of your asset to potentially decrease. And to a degree, we do expect that. It's just TBD on what degree and exactly how much that's going to impact us. But there's a few other factors that you need to evaluate whenever you're making those decisions or thinking through those, whether or not it's a good time to buy or sell or whatnot. So number one is that, it's also important to remember there is a significant amount of capital in the market. So in 2008, we saw asset valuations, they did decrease pretty aggressively, pretty much as you would expect based off of the market shifting. But one reason you might think that it's not going to be as bad this time around is the amount of capital that remains in the market. So we have actually seen more growth in Q1 of this year than we saw in Q1 of last year. And last year was record growth for the first time in quite a while. So whether it's people in other commercial spaces that haven't been as successful or lucky as us over the last couple of years, or a variety of other things, we do expect additional capital to continue coming in this market, which will drive cap rates down, asset values up. And then number two is that storage outperforms speculative assets. So we just talked about how bearish the market is, and it's rough out there, right? We saw 70% decreases on some of these really big invincible stocks. What's going to happen is, as people see, storage is becoming less and less of a secret. And as they see that storage is a more stable investment, they are absolutely going to be moving some of their money out, especially during a market condition like this, and potentially into this industry. So again, that's just more capital that we would expect. And then, yeah, the market speaks for itself. So again, if you go back to the fundamentals and start looking at things like year-over-year growth and our ability to generate consistent revenue streams or even rising revenue streams in these market conditions where the rest of the market is becoming bearish, it's just a very attractive market for a lot of folks. And the more people that are bidding, the more asset valuation is going to be there. So this is one where I don't want to come across either way. I don't want to come across too positive or too negative. The reality is, no one knows exactly how this is going to play out for asset valuation over the next couple of years, but these are at least just some things I wanted to equip you with that you can kind of think through as you might be making some significant decisions in this space. So what is a storage operator to do? Given all of the things that we've talked about, that's a lot of really, really dense information. There's a few different things from Storable's perspective that we're recommending folks think through. And long story short, the good news is, if I'm really boiling it all down, it's mostly business as usual for the short term in the self-storage industry. So what do I mean by that? Well, one is we know we're in a supply crunch. Occupancy percentages continue to stay record high. So that means if you want to grow your bottom line, you have to think about your business differently, right? You have to grow either at a revenue per tenant or a revenue per unit level, however you want to measure that. But the point is, generating incremental demand today doesn't make sense when you're already sitting at 95%. So you got to think about your business on a more granular level. But two is, I would recommend you start dusting off your marketing toolbox. So it's been a couple years since people have had to drive incremental demand to their facilities. But I do expect that this is going to be something that has to happen. We talked about earlier how some tenants are going to be moving out, other types are going to be looking for your units. So you got to start thinking about, how's your SEO doing? Is your website optimized? Are your online rentals good? All these different things. I would start doing them now so that if those market changes start happening in the next couple of months, like we expect them to do, that you're equipped and you're prepared to be able to do those things proactively. And then lastly is, being mindful of that new type of tenant. So this one is a little bit of guesswork from us, but it's pretty logical. But the idea here is that if you do have somebody who is downsizing, they're probably a different type of tenant than someone who is maybe has a surplus of stuff and is maybe just needs a self-storage unit temporarily, or they're going through a big life change, like they're moving. So you just have to be conscious about the way that you're speaking to them, the way that you're thinking about pricing. We're not suggesting that you change pricing, but just be mindful of the fact that it might need to change over the next couple of months to year. But just be mindful of kind of who that person is and how you speak to them, whether it's on your, automated communications or on your website, or, training your manager to just kind of be aware of those things. Great. So I want to talk through just takeaways. So again, I know this is a very dense presentation. There's a lot here for sure. And again, I saw quite a few questions come in, and I will be reaching out to you guys one at a time. We don't have time to get to those today, but I will follow up, and we're glad to continue the conversation on this. But there are kind of 5 main things that I want to take away. I want you guys to take away from today. One is market corrections are certainly here. So we saw that in the stock market. We saw that in inflation and rising interest rates, the inverted yield curve. Maybe you believe that one, maybe you don't. But again, it's a very high propensity to predict. Point is, there are absolutely market corrections that are here today. With that being said, we believe the storage industry continues to remain strong throughout that. That is what we saw in 2008. There is no indicator that we will not have the same level of success in this one. There's nothing that we're tracking or nothing that we're seeing that would dispute that. And number 3 is to start thinking about how you position your business in response. So this is the topic we just went over. So there are some things, whether it is getting your marketing tools ready, or whether it's thinking about your pricing, or whether, if your asset valuations, if you're looking to potentially buy or sell, it might be an interesting time to do either one. We'll let you guys kind of make that call, but you can absolutely start thinking about how you're positioning your business to respond to all of these things that we're tracking and seeing. And we're expecting ultimately asset fluctuations to probably be minimal, just based off of all of those forces we talked about from Marcus and Millichap. Makes a whole lot of sense that while some elements might be bringing asset valuations down, there's other reasons to believe that they might be coming up. So our point is that we just expect the fluctuation to be minimal. It might decrease, it might increase. We just don't expect a big change shift either way. But this is one that we're going to continue to track over time, and we'll present to you guys in these webinars, and we can continue our discussions there. But then lastly is recurring cash is huge. So you're in a really, really solid industry to ride out something like an inflation. You're going to continue to be able to capture kind of the same amount of money that you've been able to capture in the past, even in lieu of things like rising interest rates. And so whether that is putting you in a position to continue reinvesting that cash while the stock market's low, or looking at other assets, or whatever the case may be, we're in a really, really strong place in the self-storage industry, again, both from a personal standpoint and from a business standpoint. So, take that and be proud of that, be happy you're in a good place. And so that culminates today's presentation. So I wanted to give you guys just a brief look into what we're planning on doing here in the future. So as you guys know, we are big fans of the operator roundtable around here, where we bring on folks such as yourself who are actually running businesses in the self-storage industry to take the concepts that we talked about today and translate them to a little bit more applicable views into actually how they think about the world, or talking about their experience back in 2008, for example, and how they rode that out and what decisions they made and what paid off and what didn't pay off. So we'll be bringing on a couple of savvy operators to be able to continue this conversation and turn it into more of a discussion on these types of things, on all these overarching points. But that concludes it for today, guys. So again, I saw a bunch of questions come in. Really appreciate you guys taking the time to submit those. I'll be following up with you personally on all of this stuff, and we'll continue the conversation. But more than anything, just wanted to thank everybody for showing up today, for your guys' contributions, for your time. I know you guys are all busy. We appreciate it, and we'll see you guys next month for the Operator Roundtable on the same topic. Take care.
Get the power to do more with Storable software. More automating, more control, more revenue, more time back in your day. Storable helps operators do more with the most powerful technology in self-storage. Learn more at storable.com/do more.